Bonds in focus today. Wow, we could probably say that for the whole of this quarter, if not the year, but nevertheless, let's now look at how the uptick in yields will impact on equity markets. And to talk about more of this and how to structure the portfolios, what's looking good between bonds and equities, Darren Thompson from Equity Trustees is joining us this morning. Good morning, Darren. Thank you so much for joining us.
Good morning, and thank you for having me.
Pleasure. Now, it has been a tumultuous year, particularly for bond investors. So we're talking, Treasury bonds, government bonds, the sell-off, third year running, historical first apparently.
No, that's right, and I did catch a little bit of your last guest, and certainly I would concur with many of those comments. If you look at the rolling 3-year returns for fixed income, sort of your standard fixed income portfolio, it's down around 5% per annum. So it obviously hasn't been a great time to be invested in bonds over that period as we came out of the COVID period and interest rates went from those historical lows to where we are now. So it's been a pretty lackluster period, or actually a poor period to be invested in bonds, and certainly much better to be in equities. Many of our investors are long duration. They're endowment funds, charitable organisations which have long duration periods. So we tend to be overweight growth assets, but we still do have bonds as a diversifier to actually capture return and yield as well.
I guess the question, there's such a bifurcated view out there at the moment. I mean, you've got some real vigilantes. I mean, some of the stuff I've heard would make my hair go curly. Like talking about...
Not mine.
Talking about interest rates going back up to 13 or 14%. I mean, like in a totally different world. And then, of course, you have the more dovish ones out there who are basically saying this cycle has been a bit different because the lags have been very, very long for various reasons. And I guess the key question is, when really should investors be looking to add to longer duration fixed income?
Yeah, well, we think that time is pretty close to now. We've been looking at this for a while, and we had been underweight fixed income, but just recently moved to being market weight in our structured portfolios, which means around our long-term asset allocation, and we're looking for an opportunity to go longer to add to our bond position. I did, as I mentioned, I did catch a little bit of the previous speaker, and I certainly agree with a lot of those sentiments, which is that essentially the sticky services side of demand, the revenge spend that we've had over the last post-COVID period has been more resilient, and we think that'll continue to be the case, even though it now requires, I think, increasingly for households to dip into savings to sustain that. But that's likely to be the case whilst we have low rates of unemployment. And still, I think that sort of momentum maintained. So certainly we think that interest rates are going to stay higher for longer, and certainly the market has started to price that in, and we've seen that certainly in recent times with the bond market. But up and around these levels, the 30-year in the US at 4.9, the 10-year at 4.7, and our 10-year about the same. Our long-term valuation models would be that they should be lower than that. Now, so we do think that momentum will see that sustained for a little period of time, and certainly, but we think that on a sort of a 1 to 2 year basis, it's time to start to think about adding to that. And so we're looking to cautiously add to bond portfolios at the moment.
Okay, and therefore, by definition, equities, they are conversely potentially they're seeing valuation compression. There is question marks over particularly some of the EPS forecasts out there for the US are pretty robust for full year 24 and 25. Are equities starting, even after the sell-off, to be, are they still, are they looking stretched? Is it more attractive now to look at certain sectors?
Yeah, look, in terms of asset allocation, we have tended to be a bit overweight cash. We thought that equity valuations were a little stretched and that higher interest rates would adversely impact valuation. And certainly that has started to play out in the last 6 weeks. So we think that's got a little ways to go, but certainly, again, would start to be looking to redeploy that cash into markets, in the near term would be our view, particularly if this sell-off is sustained. So, you look at the higher interest rates, it certainly impacts the valuation of long duration cash flows. Dollars earned in the future are worth less today. So as rates have gone up, certainly it impacts those longer, those growthier stocks, as well as bond proxies, the REITs, real estate investment trusts, infrastructure trusts, those with lower growth are also adversely impacted. So where we're looking for, I guess we would say, value stocks where there's a lot more of the value in the nearer term earnings and have some growth. So a mix of both yield and growth in the short term.
Interesting. If we do get economic slowdowns, and again, there's a lot of different views in that department, and we get those bond yields moving down more to your long-term range that you're talking about, surely some of these really, what is starting to look at, like bombed out potential REITs and those interest rate sensitive ones, infrastructure. I mean, some of the ones in the US, dare I say, have been carted out backwards into the chopping shed. But also growth potentially might work if bond yields do start to move down at some stage.
Oh no, certainly. I think that would be supportive for those sectors in the longer term. We probably think that's probably 6 to 9 months away. By the time that the sort of cycle plays out. So again, we're trying to both retain existing value within our portfolios and then and opportunistically access that value in the future. So I guess our view would be a little bit cautious in the near term, but certainly I think those opportunities will rise going forward. Certainly in the domestic market, we would see that some of the areas which have underperformed, particularly in the healthcare area, stocks like ResMed and others that we hold that, and then there are stock specific issues with some of these stocks, but so we're not necessarily supportive of the real estate market because bonds are one factor, but there are also other dynamics like office utilisation, retail demand, and so forth.
Just briefly touching on healthcare, typically that should be resilient in these type of market conditions, but between pandemics and weight loss drugs, everything seems to have been thrown out with the baby in the bathwater. You mentioned it, are you sort of looking for opportunities in that space?
No, absolutely. And you mentioned the GLP-1 drugs, the Ozempic and the weight loss drugs. They have been a very large focus of our market. ResMed is a stock which we do hold in our portfolio, and I think is well held by Australian institutional investors, which makes CPAP devices, for sleep apnea. Certainly, those who are overweight are more prone to sleep apnea, so therefore anything that reduces obesity is adverse. It's good for people, but it's adverse. So that has had a meaningful impact. And it has a meaningful impact on a range of other things, like the incidence of hospitalisation and procedures and so forth. Look, I think there's a bit to play out in that area. Obviously, early signs are positive. There's some issues, I guess, around understanding just the cost benefit analysis, what happens if you come off the drug and so forth, and certainly how it impacts on the older demographic. So there's a little bit to play out there. We probably feel that it has been overdone in terms of the impact on ResMed in the short term. So it's more of an opportunity from this point going forward.